Hello and welcome to today's Your Daily Five. I'm Tom Bowley, Chief Market Strategist of earningsbeats.com, and I'm happy to join you on this Thursday, May 28th. This first chart that I want to show you today is actually a chart that I believe I featured the last time I was on Your Daily Five. This is a long-term chart of the S&P 500, and really it drives my overall belief in the market, whether I'm bearish, whether I'm bullish. And if you follow any of my blogs at StockCharts, you know that I've remained very bullish over the past several years through the trade war, through the pandemic, everything. I'm keeping focus on this long-term chart because I believe that we are in a secular bull market that will continue for the next several years, maybe even a decade. But it doesn't mean that we won't have pullbacks. But as you look at this chart, I want to just point out first the three shaded areas. You might look back and think, well, these are just blips where we didn't do much for a while. Well, it's not that we didn't do well for a while. We're talking about 12, 13, 14 years of not doing well. So from the 1937 when we topped all the way through into the early 1950s, we could not take out this high that was established back in 1937. So imagine 13, 14 years not being able to take out an earlier high. That's what the market was looking at back then. You look at 1969 all the way through the early 1980s, same thing, struggled, went sideways for a long period of time, went almost nowhere. Then you look at 2000 to 2013, same thing. If you've been in the market for a while, you know exactly how it felt back in the 30s because we did it again, 2000 to 2013. Went nowhere. We had this double top on the S&P 500 around 1560. Once we cleared it, in 2013, in my opinion, we now began the next secular bull market, similar to what we had back in the 50s and 60s and also in the 80s and 90s. Now, these moves to the upside don't come without some pullback, though, and without some selling. You still have cyclical bear markets within secular bull markets, and that's what these red circles highlight. You can look right here. This was the 1987 market crash. It looks like a blip on the radar now. It didn't look like that when we were in the market crash. I can promise you that. I remember it. I think when we're looking back in another few years, we're going to look at this pandemic in much the same light as we did the 87 crash. I think we're going to continue breaking out to the upside. I remain very, very bullish this market. And the next chart, I think, will show you what I believe is going to be the catalyst for driving the stock market higher. When you look at this chart, this is the 10-year Treasury yield. It's a 5-day moving average of the 10-year Treasury yield. And down here on the bottom is the S&P 500. When the yield is moving down, it's telling us money is rotating into Treasuries, which is very defensive. Why would folks get into Treasuries? Well, they're not confident about something or they're fearful. And normally that same level of fear is what drives the S&P down or sideways for a period of time. So these red shaded areas, you can see we got the 10-year Treasury yield drifting lower, and the S&P 500 during these periods tends to struggle quite a bit. But look what happens when the 10-year Treasury yield moves up. This is what's referred to as rotation among asset classes, where we're seeing the yield go up, meaning Treasury prices are going down. Treasuries are being sold. That creates proceeds. Those proceeds then move into stocks. The reason you would sell Treasuries is that you believe the economy is strengthening. Well, if the economy is strengthening, that helps the stock market. So here is your move, these moves up, which are combined or associated with these moves up in the S&P 500. So if you're looking to see what could be a driver of the S&P 500 over the next several years, or at least the next couple of years, I think it could be the sudden movement back to the upside in the 10-year Treasury yield as money rotates. Let's move on to our third chart. They've been tremendous laggards. And we've seen now for almost 2 years, from back in the middle of 2018, now into the latter part of May of 2020, a very significant decline in terms of small caps and their relative performance to the larger caps, to the S&P 500. If you go back all the way to 1999, for the most part, small caps have been outperforming. But this has been the longest period of underperformance over the last 2 decades. I think we could just be starting to turn back up again. I don't know if small caps continue to underperform. I think we're likely to see this change. And when it does, I think we could see a significant amount of outperformance by small caps. Think back to 98, 99, we had this huge drop, and look what happened afterwards. I think we could be setting up for something like that. So that would be another theme to keep in mind. A fourth chart I want to take a look at here is the Nasdaq 100 relative to the S&P 500. And this has just continued to spiral higher and higher and higher. We go back now 17 years, actually 18 years since 2002 in this uptrend. So the Nasdaq 100 continues to outperform the S&P 500. The key here is interest rates continuing to fall, and you've got many of the high growth companies on the Nasdaq 100. So as companies grow their earnings in a low interest rate environment, those companies that can grow faster have earnings that are much more valuable. And when you're looking at the market right now, think about where you would want to put your money. Do you want to invest in a 10-year Treasury yield that'll pay you the whopping sum of 0.7% for the next 10 years? Or would you rather take companies that are exploding their earnings to the upside, which many of the companies on the NASDAQ 100 are doing right now, especially in the healthcare and technology area? Would you rather just take that fixed 0.7%, the Treasury, or would you rather buy these earnings that I believe are only going to become more and more valuable as interest rates move closer and closer to all-time lows? Actually, we are at record all-time lows. So, my background being in public accounting many, many years ago, I've done valuations. And I know when I see folks talking about the PE ratio being too high relative to history, well, you have to realize when you look at the historical valuations, currently, we've got interest rates we've never seen before. Companies deserve higher PE multiples. There's no doubt in my mind. So anyway, keep that in mind here as you take a look at something like the NASDAQ 100. I believe we could see a pullback because we've had so much relative outperformance, but keep this long-term trend in mind. I think it will continue. Lastly, one thing that this market has been doing over the course of the past few months is it has increased the fear immensely. And so you've got a lot of folks that are jumping into short positions or have jumped into short positions. Even as we rally, there have been so many folks saying, oh, this is a bear market rally. So they keep shorting and shorting and shorting. Some of these companies have tremendous short interest. And as they make breakouts, they absolutely explode to the upside. I wrote about OLLI's Bargain Outlet Holdings back on May the 12th. And here was the article that I wrote, seeing a short squeeze unfold presents huge opportunities. I wrote this when OLLI's was just making this breakout here above the $70 level. It was trading at 73. Now, as we look at the chart, you can see just a couple weeks later, we're up over 90. The stock is at 91 and climbing. It's got an all-time high around 103 that was set 1 year ago today. I think it's going to make a move for that area. And this is just the third of a line of stocks that I've provided in my various blogs at Chart Watchers and Trading Places, where I've shown some short squeezes that have worked out really well. I've got another one that I'm going to provide to Earnings Beats Digest subscribers. This is our free newsletter over at Earnings Beats. You can just put your name in, your email address, hit subscribe. Tomorrow morning, Friday morning, before the market opens, I'll give you another one of these short squeeze candidates that I think will be awesome for you to take a look at. While you're over here, you can sign up. We have a 30-day, fully refundable $7 trial. We'll actually let you download the chart list. So great feature here. Go to earningsbeats.com. Check this out. Love to have you join us over at Earnings Beats. It's been a pleasure being with you on your Daily 5 again today. Have a great day, everybody. Happy trading.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.